Good evening, everyone. Welcome to our third part of our CME Masterclass. So tonight is an introduction to the CME's Group's listed FX products. And I'm sure a lot of people out there were not aware that you could actually trade currencies if you're a Forex trader and you're interested in the major currency pairs and some of the new emerging currencies that are coming through as well. That you can actually trade them through the futures exchange, through the Chicago Mercantile Exchange. So tonight we're very fortunate to have Ravi Pandit from the CME Group in Singapore, and Ravi is going to be giving us his expert understanding of the CME FX products, and I'll be also supporting him in that as well. But Ravi's got a lot of great information that he's going to pass on for us today. So if you're interested about currencies, there's no better time to learn, and there'll be some interesting facts and figures that you will learn tonight from Ravi. Hi Ravi, how you going?
Yeah, I'm doing fine, thanks. And hi everyone.
Good. Yeah, we've got it's been a big week for us, well, the last week. So we've had lots of webinars on and lots of activities. So we're on a roll. So there's no better time to be bringing you in, because there's such a massive interest in the futures markets nowadays, and also, you know, in Australia there's been lots of negativity over some of the Forex brokers that are operating, and a few of them have been basically shut down from operating due to some you know, manipulations of price and things like that, and it's a shame that people that trade through some brokers can really can have a difficult time. And I think the beauty of trading Forex through a futures contract using the CME Group's products, it's a lot more of a regulated and a contained market, not as large as the spot Forex market, but it doesn't need to be, because there's enough volume out there for you to be successful in trading these products. But you just know you're in a very contained and regulated environment. That's a very important thing to know. If you are trading Forex and you love the major currency pairs, then you know there is an opportunity with the CME Group's FX futures products.
Sure.
So before we, oh, Ravi, did you want to say anything about that?
Yeah, sure. I think you gave a great introduction. So if I may add a few words to that, you know, you mentioned future sizes being not so large compared to the, you know, overall cash market. Just to put things in perspective, the cash market is about 6 trillion a day, of which about 4 trillion or so is FX swaps, which are, you know, typically funding trades. A bulk of that is like, you know, Tom next, spot next funding trades. So about 2 trillion of that is spot. And that is highly fragmented. The spot market is highly fragmented. So if you look at individual platforms, they tend to be similar size to CME. So the large individual platforms, you know, Reuters, EBS, etc., they tend to be around $80 to $100 billion a day, which is very similar to what CME's FX futures volumes are.
Right. Yeah, that's good clarity. Yeah. So there's a large enough marketplace for people to be able to trade the products on a daily basis or on a longer period of time. There is enough volume out there. So it's a very large marketplace. So tonight, what we're going to go through is a little bit about our compliance first. Then I'm going to hand you over to Ravi. And apologies for that, your surname there, Ravi. But it is Ravi Pandit. And we're going to also talk about why we trade futures markets and why we specialize in the futures markets. Also, we're going to go into a little bit more detail around the futures, the FX futures market or contract specifications is important to understand. We'll also do a little bit of analysis at the end in terms of, you know, where these prices may go on some of the major markets. Also, we'll do a Q&A session as well, and we're going to wrap up there. So quickly just need to go through this compliance, and also if you can read along, that'd be great. I'll just go through some of the key points. There's just a few slides I just need to go through. We are the International Day Trading Academy, and we are corporate authorized representatives of Beyond Capital Asset Management, and this is for the purpose of futures trading education. We do have to let you know that trading futures and other products on margin does carry a high level of risk and may not be suitable for all investors. Also, there's a high degree of leverage can work against you or for you before deciding to invest in any futures products. You should carefully consider your investment objectives, level of experience, and risk appetite. And also, there's a possibility exists that you can sustain a loss of some or all of your initial investment. Therefore, you should not invest with money you can afford to lose. You should be aware of all the risks associated with futures trading and seek advice from an independent financial advisor if you have any doubts. And there's two primary risks. You have the risk of making money when you take a trade. You also, they're called winning trades. You also have the risk of losing money every time you take a trade. These are called losing trades. And also tonight's presentation is general information only. So we are not financial planners. We don't take your personal objectives into consideration. And also just past performance caution notice. So if I do give any forecasts or any information about where the likely market will go in terms of price movements, past performance of this product is not and should not be taken as an indication of future performance. Caution should be always exercised in assessing past performance. This product, like all other financial products, is subject to market forces and unpredictable events that may adversely affect future performance. So just a little bit of background about myself. I am one of the founders of IDTA. I'm a passionate day trader, also an educator. I do some mentoring and coaching for our students. We run a lot of programs, like we've got a trading business school program that we focus on educating our students to become business people in the world of trading. I'm also a qualified teacher, got an extensive history in trading the world with the futures markets and also share trading. I do love studying the market cycles, forecasting, also passionate about science of peak performance. And also you'll see some of my articles in the Your Trading Edge magazine, which is one of the leading trading magazines in Australia. A bit of background about IDTA for any of our guests in tonight that aren't members of IDTA. Just we are a specialist in trading the futures markets and educating people how to trade the futures markets. We have members in over 21 countries, up in Malaysia, Singapore, some of the countries we've got members in Asia. We've got a team of professional traders and coaches, not just myself, there's a large team. We also provide proprietary trading systems and indicators. We also have 4 different trading rooms. We do US, a pre-US market, a European open, and also an Asian trading room. And we've got 14 trading hubs around the country, and we have a few overseas as well. So tonight we're going to run through, how you can use the FX futures for your long-term trades, even your short-term day trades. There's enough volume to be a day trader with these products. You can trade them long or short, which is for some of those people who are very new to the futures markets. That means we can trade when the market goes up, we can buy when it goes up, and we can also sell when the market goes down. So we can, that's called short selling. We'll give you an opportunity to really trade one of the probably the largest traded asset in the world, being cash and currencies. So you do have exposure to that. You've got the ability to trade basically 22 hours a day, or almost 23 hours a day, 5 days a week. And the beauty of trading the futures market is that we trade direct to the exchange. So we don't have any really many brokers really dealing with the trades. Everything is done directly up onto the futures exchange. So it's a very clean playing field. We're trading with basically all other traders in the world. You talk about banks, central banks, hedge funds. We all have equal access to the market, and what price we see is what everyone sees. So it's a very fair and transparent marketplace, as opposed to some of the other platforms. If you were going to trade forex or currencies, sometimes you do not quite see the correct price. So this is, if you're trading in the exchange, the Chicago exchange, you see everything that everyone who's trading in that exchange. So it's a very clean, transparent playing field. It's a very important thing to know. Oh, before I move on to the CME futures overview, what I'd like to do is hand over to Ravi. Ravi, I'm going to give you the presentation, and I'm just going to hand that over to you. And Ravi's just going to share some very important information from the CME regarding the futures products, that the FX futures products. There we go. I can see your screen.
Yeah, I'm just trying to make it the presentation mode. Okay,
yes.
Is that good?
Yeah, perfect.
So yeah, I think you've covered a lot of aspects which I was going to touch on, but as a matter of introduction, just introduce myself first. So my name is Ravi Pandit. So I'm looking after the rates and FX business at CME Group in Singapore for APAC, which also includes Australia, by the way. And I've been with CME Group for the last 5 years. And before that, I was a trader of rates and FX at various financial institutions for several years before that. So quick look at the disclaimer. This is something we have to present at all such presentations. So before I look at the FX futures market overall.
Sorry to interrupt. It looks like, how we did the test, and it looks like the format's been skewed. It's not. I can't see the whole slide. It's just cutting off a little bit on the left-hand edge.
Okay, 1 second. How about now?
Yeah, perfect.
Yeah, so a quick look at the history of FX futures on CME. So these were actually the first financial contracts launched on CME in 1971. So you can see how far back they date. So CME Group, by the way, is formed by the merger of 4 exchanges: CME, CBOT, NYMEX, and COMEX. So one of them, CME, was the one which launched FX futures in 1971. And like I mentioned, they were the first financial futures. So even when you look at interest rate or equity futures, they came after the FX futures at CME. So taking a look at how FX futures are traded globally, you can see the relative performance of CME's FX futures complex compared to other exchanges. So if you look at the daily volume, ADV stands for average daily volume. We were at about 70% in 2015, and we are currently at around 50%. So that change from 70 to 50% has been driven mainly by just one exchange, the Brazil B3, which is highly concentrated in just one contract, which is the Brazilian currency contract. But with regards to the overall share compared to other exchanges, we've held pretty steady, and we're one of the largest FX futures exchanges in the world. When you look at the open interest, so these are the open positions which people hold. We are close to 60% of the open interest across all the exchanges. So that just tells you about the share of CME in the global listed FX complex. Taking a quick look at what it comprises. So our daily volumes are just over $80 billion a day. As I mentioned earlier, these are quite in line with some of the very large spot ECNs like EBS. EBS is also now under CME Group. So they also do roughly similar amounts, and Reuters is also more or less similar amounts. So CME Group is considered a primary venue for FX, just given the size of the market. What does it comprise? We have 53 futures, monthly and quarterly, 24 currency options, with a range of expiries. FX Link is a unique product which helps clients link between cash spot and CME future, and it's like a synthetic FX swap. So that's unique to CME. 23 hours of trading daily. So the only time when the systems are being set for the next day, that's when the market is shut. But that pretty much covers the entire trading day. Besides the trading of FX, we also offer clearing of FX, and we also offer optimization. So it's a complete solution with regards to FX products. So before I just look at these volumes slides of CME futures, just to make sure everyone understands what an FX future is. So just like any product or any future is the forward price of any underlying commodity. An FX future is a standardized contract which essentially gives you the value of the FX currency pair in the future. So in the OTC terms, it's like an outright forward. So that just explains what an FX future is. So looking at the daily volumes of our futures contracts, so this chart is in number of contracts. You can see it's hovering between 800,000 to 1 million contracts daily. So that is quite a substantial volume on a daily basis, and it has sustained, at these levels over the years, through all kinds of cycles. The spikes you see are periods of heightened FX volatility, like for example in March this year, we had very high volatility, and as a result, we did 1.4 million average contracts on a daily basis. So taking a look at the same in dollar notional terms. People tend to familiarize themselves with dollar notional more than number of contracts. So in a dollar notional terms, it's anywhere between $80 billion to $100 billion on a daily basis. Once again, the spike we saw in March this year was just about 120 billion contracts. So this is quite huge by any yardstick, and it's a measure of CME's strength and resilience in the FX futures market. We also like to measure our open interest. This is typically clients holding an open position at the end of the day because they like to carry the positions to either hedge an activity or they have a view which they want to run for a certain period of time. And it's a good measure of end user adoption of a particular product. So the open interest in terms of a number of contracts is anywhere from 2.25 to 2.5 million lots daily. And if you look at the same number in dollar notional terms, it's close to $250 billion. So when you compare the open interest with the daily volume, which was between 80 and 120 billion, you can see that the open interest is a multiple. It's like 2 to 3 times the underlying daily volume, and that is a good measure in terms of the health of the product, because it's not just a product which is being swung around by market makers, but there is end user adoption which is holding open interest in the product, and that does provide liquidity and stability to the market. Notice the green area refers to FX options. So besides futures, CME is also a big market for listed FX options. So taking a quick look at the basic features for a FX futures contract. Typically, futures tend to be standardized. So we have standardized tenors. For the major currencies, these tend to be the quarterly March, June, Sep-Dec expiries. One of the reasons we can get liquidity is because of the standardization. Had there been futures for every single date out there, then there wouldn't have been as much liquidity as there would have been for a standardized tenor, because it tends to concentrate the liquidity on that date. The notional is defined because people need to know what they're buying or selling, so it's a fixed notional. Regulated, so this is something we take pride in. So we are regulated by some of the most well-regarded regulators globally, so which makes the product accepted widely. Typically, product involves a placement of margin for trading. So there's an initial margin requirement which needs to be placed before trades can be done. And then they're marked to market on a daily basis, any positions. So any profit or loss is either received or paid via variation margin on a daily basis. totally anonymous because you don't know who's the buyer or who's the seller. I mentioned that futures and options are available. It's a wide mix of currencies. So we have major currencies as well as emerging market currencies. So it's your choice what you trade. And the contracts are physically deliverable, as well as there are certain NDF currencies which are also listed. I mentioned that we are considered a primary venue, and the biggest market for FX is spot, right? But CME futures are considered as a proxy for spot. So if you think about the pricing of a future, it involves spot plus the forward points between the currency pair, between spot and the outright forward date. So as you can see, spot is a big component of the pricing of a future, and the futures are very highly correlated to spot. So in fact, some of the market institutional participants use up contracts as if it was a proxy for spot, just because the price discovery in our complex, in the futures complex, it tends to be unique and different from the spot market, which tends to be dominated by a few financial institutions. So because of the unique nature of the liquidity for futures, it's considered a primary venue and it's considered also a proxy for spot. The pricing is credit agnostic because it's all based on margining, and anyone, even a retail investor versus a large hedge fund versus asset manager versus a large bank, they all basically are seeing the same market. So it's open to all, and it's, everyone's seeing the same pricing and paying the same margin. Some more detailed look at what FX futures involve. So there are exchange fees and broker fees, but everything is known upfront. So there's no like hidden costs, and these are all published, publicly available. What fees anyone has to pay. In terms of credit, I already mentioned that it depends on margining, so it's kind of credit agnostic. And because of the fact that the positions face a clearinghouse, you're not facing any individual counterparty or a broker, etc. You're facing the clearinghouse. So that also mitigates some of the credit requirements. The margin requirements are calculated on a 1 to 2 day period of risk, and these are known upfront, and they are available on our website as well. The way typically if the futures market works is that we have clearing brokers who essentially face the clearinghouse, and anyone wanting to trade the product has to have a relationship with the clearing broker. So although you trade on the exchange and you're facing anonymous counterparty for the pricing, the margining, etc., is done through a clearing broker. So there is a role of a broker as well in terms of the actual back office processing and handling of positions, etc. Execution can be electronic. There are several modes of execution, and it's available on handheld phones to web platforms, etc. And it's through a variety of sources. I mentioned that it is a central limit order book. So the unique thing about this is that it's a completely level playing field. So any retail investor could be facing a large hedge fund on the other side, and essentially both have access to the same prices. There are a multitude of participants who provide liquidity, and these are different types of end users. I mentioned regulations. So CFTC is the main regulator, and we are also regulated by the FCA and Bank of England in the UK. The next slide looks at why FX futures are gaining importance from an institutional perspective. So traditionally, institutional FX has been mainly interbank or with banks, but there is an increasing role for listed FX. In the FX landscape, and some of the reasons for this are qualitative reasons. So there is no regulation which requires clearing for FX, but there is a global code of conduct which defines how things should be conducted. So there are terms you may have heard of like best execution, firm liquidity, and other such terms. So our futures contracts offer these terms on a standardized basis. And these are some of the qualitative reasons why clients are, enjoying the deep liquidity we offer and satisfying all these, soft regulatory requirements. So what are we doing to address the FX market needs? We are providing a transparent and liquid market, which is an all-to-all marketplace. We pride ourselves in the breadth of participants. So we have, all kinds of participants who are trading the same price. For institutions, it's a capital and credit efficient model. Clearing always provides capital efficiencies. So, for institutional clients, this is something they enjoy. It's very simple from an operational perspective, and the execution and clearing happens at the same venue. So that makes it quite straightforward. And, reach. So it's available globally. We have brokers in all kinds of jurisdictions, and the trading is available 23 hours a day. And for most of the products of the FX space, the liquidity is also during the entire trading day. Lastly, a quick look at some of the tools which are available on the CME Group website. So I've picked out this tool, which is called the Commitment of Traders report. And this is something which is actually produced by the CFTC. But we, kind of represent it in a very user-friendly fashion. And you can find it at the link, which is mentioned at the bottom of the slide. So I've taken Aussie dollar as an example. And what this slide shows is for there are people holding open interest in different categories have to report their positions to the CFTC. And, these are typically classified as dealer, which is like banks, asset managers, which are real money accounts, leverage stands for hedge funds, and other reporting traders. And then the gray is non-reporting. So by definition, a futures position is matched. All the longs and the shorts offset each other. So each column, which is each reporting date, will have an equal long and short. But you can see the breakdown is different. So, for example, if you look at the first set of columns and look at the green areas, you can see there are many more open interest positions for hedge funds than there are long positions than short positions, which showing that the net long positions for hedge funds, net position for hedge funds is long in Aussie dollar futures for that date. So this is very interesting information from a trader's perspective, because you can form views on how the market is likely to move in the days ahead based on how people, the holding pattern of different categories of traders. So there are many more other tools which are available, but I just wanted to present this one tool. And you can access the website if you wanted to look at some of the other tools. We also have a whole bunch of white papers and guides which help FX traders who are interested in learning more about futures. So I've listed some of these on this slide. There's a FX Product Guide 2020, which is basically the Bible for FX futures. It's got the complete set of contract specifications and other material as well. In addition to that, you can see the range of white papers available. So anyone interested can access this free of charge on the website. So that's it as far as my presentation goes. So back to you, Cam. You might be on mute, Cam.
Thank you, Ravi. Is that coming through now?
Yes, now it is. Yes, thanks.
That screen, is that playing?
No, we can see it. Yeah. Now it's gone. Now it's back. Yeah.
It's back. Yeah. Brilliant. Okay. All right. Thank you, Ravi, for that succinct and very clear explanation of the key factors around the FX products. And I think the key points that I got from that is that it's a highly liquid market, and it's a very solid benchmark for it acts as basically the same as the spot price. Really, they work very close together. And here's a few key points too that you may want to understand as well, is that the international monetary market dated FX futures forms the backbone of the CME's FX franchise. The majority of the participants use the international monetary market future as the CME as a proxy for the spot pricing and liquidity. It's very important that we've seen an increase in very strong growth of holders in the large open interest positions. It has increased. So there's a lot more players coming into the market. You can see from that graph, you can see the increase in the overnight interest holders or open interest holders. So people holding longer term positions is a good sign that there's lots of liquidity backing these markets. Also, too, like the prime markets we do trade are all quoted against the US dollar. Most of them are. There's a few that are backed against the pound and the euro, but majority are backed against the US dollar. So you would see, if you were trading in a forex product, you'd see a lot of the major pairs, and they would be mainly, there'd be it could be the US dollar versus the Japanese yen, or US dollar versus the CAD. But with a lot of, well, the majority of the FX products, they're all traded against the US dollar. So it'll be the euro versus the US dollar, the Great British Pound versus the US dollar, the Aussie dollar versus the US dollar, and the Canadian dollar versus the US dollar, and the Japanese yen versus the US dollar. So that one is flipped. You can see there the inverse JPY, CAD, which is the Canadian, and the CHF, which is the Swiss franc, is normally US dollar versus those products, but these ones are actually flipped and inverse. So you can trade the Swiss dollar versus the US dollar if you wanted to. However, the ones up the top there are probably the major currency pairs, and also the yen are the majors, but we'll go into other ones as well. There's a lot of emerging currency pairs that are coming up as well. Ravi mentioned this also, is that the average daily volume is around $82 billion, and we've seen a record number of large open interest holders on the February 25th, 2020. So we're seeing some records in that, and I think you need to, as you can see down below, for them to be reported, you've got to have at least large open interest holders. You have to have at least 400 open contracts to be on that list. So that's 1,310 might not show a lot, but if they've got over 400 contracts plus, then they're large holders. So there's a large product suite. Not only are there the main contracts, there's also mini and micro contracts as well for people with smaller account sizes. You can hold obviously a lot larger spread in terms of your risk. If you need to hold off, maybe a few more cents of risk, you can do that with a larger using the micro contracts because of the decreased leverage, and we'll go through that very soon. There's lots of new emerging markets. That's what the EM stands for, and other crosses as well. So the FX products are becoming a lot larger, and as we can see with the growth in the emerging markets like Brazil, obviously China's, we know China's been emerging and is a powerhouse. Brazil, some of the other South American countries, South African rand as well. Those products will become more and more interesting as time plays out, particularly as we can see the growth of the, obviously we saw a wonderful presentation on the weekend at our annual conference where David Martin, one of the key speakers there, spoke about the impact that the China belt is going to have. That increase growth in those areas is going to have a significant effect, and we'll see a lot more interest in these currencies as these countries become these emerging countries become real major players in the economy. South Africa was a country that I was very intrigued about, but when you think about it, the amount of resources that that these African countries have, and that works very, very strongly with currency. If you look at the Australian dollar the Australian dollar price is very much related to iron ore prices. If you track an iron ore price chart and the Australian dollar chart, if you overlay the Aussie dollar versus the US dollar, you'll see a very similar correlation in the way they move. So it'll be interesting when we see these African countries expand, the effect on their currencies as well. So there's some wonderful opportunities in these emerging markets that we'll see in the future. So it's a very important place to look if you're looking for alternative investments or alternative trade opportunities. Some of these other currencies, these emerging currencies, could play a part in your portfolio. So don't discount them, even though the volumes might not be larger than these ones. Like you're looking here, the 6E. So when you look at these product specifications, you'll see that they have a product code. So the Euro futures, which is Euro versus the US dollar, the code is the 6E. So if you're looking for this, that's how you need to find it in any of your platforms that you're trading. The Japanese yen futures is 6J, British pound is the 6B, Australian dollar is 6A, and the Canadian is 6C. And then there's also this one here that I'm not that familiar with, is the Euro versus the Great British Pound, which is a larger contract as well. Now they all have a contract size. So these are all the actual what you're trading. So when you're buying or selling a contract, that's the actual value of what you're buying and selling. However, in our situation, we generally don't settle on these. We're generally trading these products, and we're just sort of keeping or losing the difference between what we trade. But that's obviously increases obviously gives it a leverageable product. Now all of the contract months very similar to the indexes. They're 3-month contracts, so they'll expire at the end of the major quarterly months. So we've got if you start from where we're going now, we've got December quarter, then you've got the March quarter, you've got the June quarter, and then you've got the September quarter. So you'll find that these contracts do expire on the 3rd Wednesday of that last month, and then they roll over into the new contract. Now, all of the prices that you see, when we look at the charts, you'll see that all the prices are quoted in US dollars. So it's basically just telling you, when you look at the price action, you'll see what, for instance, if you're looking at the 6E, you're looking at what €1 is worth in US dollars. Right, that's what you're looking at. That's the underlying. Also, when you're looking at the yen, you're looking at how much US dollars is 1 yen worth, and then how much Great British Pound is 1 US dollar. Sorry, what 1 pound is worth in US dollar. You'll also see what 1 Aussie dollar is worth in US dollar, and so on and so forth. All right, so you'll see this when we go into the charts, what that all means. Now, also too, if you want to know the tick values, I'll show you on the major markets what the tick values are in a chart. But there's lots of information here, but I'm not going to go through all of this in detail. In terms of trading days, you can trade. Obviously, the markets are open 24 hours a day. Virtually, they have normally 1 hour for the service to reset. You get the weekends off. But like I said, the contracts will expire on the 3rd Wednesday of that contract month. So, like if the upcoming contract, which is the December contracts that we're trading, if you're trading the 6E, it'll be the 12/20 contract. That 12/20 contract will obviously expire in December, the 3rd Wednesday. So then you roll over into the March 21 contract. So all contracts are settled, obviously physical delivery. So they're all, if you do go into expiry, you will have to obviously be delivered the currency that you're trading, the trading hours. These are all Chicago times here. So these are all US times, but you know, they open on Sunday afternoon in the United States, which is Monday morning in Australia, around about 8 o'clock at the current time, and then they trade through till 7 o'clock the next day, Queensland time. So they're open for, you know, these markets are open a very, very long time. Position accountability, not 100% sure what that column means. Ravi, did you want to add what that means there?
Yeah, so that's, if your position is above that size, then there's some special reporting required. So the sizes are quite high, so it's typically not that relevant for most players.
Gotcha. That's right. So if you're then a lot of those reporting will go in those commitment of trade documents you explained before. That's correct?
Yeah, that's right. And some of these are soft limits. So, you know, the reportable limits, it's just that, you know, someone may ask you a question that do you have the margin to support it, etc., that kind of stuff. So, yeah.
Yeah. Awesome. Anyway, I'll keep moving on. Now, I just broke down this chart because I think it's important, all this table, just to show you just some of the real specifications that when you're looking at these markets for the first time, what that all means. So when we're talking in the futures markets, we talk about ticks rather than pips that you may be familiar with if you've traded Forex before. Now, ticks are basically the smallest fluctuation of price movement. Now, if you're trading the 6E, which is the euro versus US dollar, the smallest size that the market can move is that very small fraction of basically 0.000005, all right, of a dollar. So it's a very small fraction of that dollar is the smallest move. Now, even though it's a very small move, and this is why I talk about the leverage factor, that one tick move is actually worth $6.25 US. All right, so if you go for let's say you wanted to make a 10 tick trade, that was the size of your target, it would be 0.0005 of a dollar, and that would be worth to you, if you made a 10 tick trade and it was a winning trade, it would be worth $62.50. Now, let's have a look at the 6A, which is, this is the code for the Aussie dollar versus the US dollar. Now, one tick is basically 0.00001 US dollar. Once again, a very small fraction. Now, if one ticks, if markets move in one ticks, it's actually worth $10. So that's what the contract value is worth. Now, a 10 tick trade is 0.0001, and the number of ticks, if you receive a 10 tick trade, or if you go for a 10 tick trade, it's worth $100. So you don't need a lot of movement in these markets in terms of the price fluctuation to actually take advantage of these leveraged values. Now the yen, now this has, you know, basically 7 decimal points, 0.000005. Once again, it's very similar to the 6E in terms of its tick value, $6.25 US. If you get a 10 tick trade, that's how far it has to move, all right? And a 10 tick trade is worth $62.50. So they're all very, very similar in terms of their pricing. The British pound, very similar tick value to the chart value is 0.001, same as the Aussie dollar. However, the tick value is $6.25. So it's important that you understand the money when you're trading these markets. Obviously, it's a key point of risk to understand what you're going to make and what you could potentially lose as well. And a 10 tick trade is $62.50 US. Now, these ones down here, these codes, I use the 6E and the 6A, but with the M in front of it, that stands for the micro contracts. And the micro contracts have been around for, I don't know, how long have the micro contracts been around for, Ravi?
Don't know the exact date, but they came much later, you know, when, so I can get back to you with the exact date.
Okay. No, because I know the micro contracts have been around a bit longer than the micro contracts on the index products, because the index products were only released last year. But once again, the difference here is the tick value. Okay, so for every 0.0001 movement in price, it's worth $1.25. So it's basically a tenth the size of the normal 6E contract. So the good thing about this is that they're lower leveraged. So if you have a smaller trading account size, and let's say you're holding an overnight position, or you're going for a larger trade, longer term time frame, let's say you're a swing trader or you're a position trader and you're holding for a longer period of time, having this smaller tick value is very important if you're holding larger size spread of risk. All right, so that gives you that ability to give the market a little bit more breathing room, and not obviously be taken out by a sudden spike in price, and then the market continues to go in your direction. You can allow the market to have a little bit more breathing room. Now a 10 tick trade would be $12.50 US. Now we've got also the Aussie dollar. I thought I'd show the Aussie dollar because that's obviously close to home, and it is a very tradable product. It's a very popular product to trade. When I go through the volumes, you'll see the volumes of product which is traded. This one here is once again very similar in terms of price movement, 0.0001. However, the tick value is $1, so it's less. So it's still a tenth the size of the 6A, but it's a little bit less than the 6E. Now a 10 tick trade on this market would be worth $10 US. So it's important to understand the money, I feel, when you're first looking at these contracts. Now this gives you an idea of the leverage. All right, so for an Aussie dollar US dollar contract, if you looked at the current prices at the moment of the currency compared to the US dollar, you would say that $100,000 worth of currency would be worth 71,000 US dollar. Now here you can see the initial margin. Now these are the margins you need to hold if you're an overnight position trader. All right, so this is the money you need to have in your trading account if you were going to buy one 6A contract, all right, or sell one 6A contract. So that's what you need. However, if you're trading intraday, the margins are significantly discounted. However, you would need to contact your clearing broker or your clearing house to get the actual numbers on that, because they will vary based on who you're trading through. So you can see the margins do vary based on the size of the contract, the notional value. You can see here the euro, 125,000 euro would be worth $144,000. All right, so that's what one contract would be worth at current prices, and this is the margin. You can see it's a lot larger in this situation. So I won't go through all those, they're pretty straightforward, but you just need to understand that you need to have, if you're going to hold an overnight position, you need at least this amount of money in your trading account. That is the margin that you need. But remember, you only need this amount of money, but you're trading this contract worth this much money, all right, in US dollars. So this is where the leverage comes into play. Now these are the micro contracts, and this is the reason we talked earlier about being able to trade the micro contracts. You can see the values are a lot less, about the tenth the size of the standard contracts, and you can see the margins are a tenth the size as well. So once again, for smaller trading account sizes, you don't need to have as much money in your account overnight to be able to trade these products. So these products, if you're looking for a longer term position, these are the ones that I'd be looking to use, these micro contracts in these longer term positions, just so that they can handle and manage the risk more effectively. Now this is these are basically the order book. So when you are looking at the what we call the depth of market, if you've got a trading platform that can show you the depth of market, and this is the great thing about the futures markets, we get to see the depth of market. This can actually tell you the number, if you can see in this column here, the number of contracts which are available or which are being on the bid side. So these are basically buyers sitting on the bid wanting to buy. So they're basically what we call resting orders or limit orders in the market. And then you can see on the other side, these are the offer or the ask. You can see how liquid these markets are. So at this point, you've got 33 contracts at that price, and then you've got 200. So you can see that there's there's enough volume to be able to liquidate at the price that you want to trade, and very minimal spread between these markets as well. So very between the bid and the offer, which is a very important part of trading, is that you're getting in for that fair value. All right, so there's no 0.001 spread, or there's not a large amount of spread between the bid and the offer, where we just see in Forex can be fairly large spread between them, and that's obviously a lot of that is taken into the that's obviously the money that the brokers will be making on the transactions. All right, so in this you don't pay for these spreads. All right, you do pay commissions to get in and out, but they're fixed and they're standard, so you know what the costs that you need to pay when you get in and out of the market, but you also know that you're buying the exact price that you want to get at. All right, so that's important to know. You can see here the Euro US dollar futures here. You can see here the volume was a little bit less. I'm not too sure what time this was taken at, but you can see here you can see it was probably quite early in the day, because you can see the volume here. This is 25,000 contracts have been traded, whereas the average volume of the Aussie dollar, you're looking anywhere from around about 80 to about 150,000 contracts traded on a daily basis. So that's fairly low volume at the start of the day. And then you can actually see the open interest. You can see that there's 134,000 contracts which are being held. You can see here the Euro, the 6E, has a very large open interest. It's probably the most traded of the FX futures products. So if you did want to look at trading an FX product, the Euro versus US dollar is probably the most liquid one that you'll be able to trade. If you're a day trader, this may be the one that would probably move the best, and probably the most consistent in terms of the liquidity. But once again, there's loads of volume in these contracts. So now these are the four probably major ones that you'll see, and you'll see that there's virtually no spread between the prices, between the bid and the offer, and you can see the volume is fairly substantial. Now, here's some examples of volume that was taken from the market yesterday. These open interest figures are taken from yesterday, and these are just averages, rough averages of volume which is traded on a daily basis. So as I said, the 6E is probably the most liquid of the markets. You've got about 150 to 200,000 contracts traded on a daily basis, over 625,000 open interest, right? So that's held contracts at the moment. The Aussie dollar, about 80,000 to 120,000 contracts a day. The 6J, or the yen versus the US dollar, you've got 70,000 to 100, and then you've got the pound, which is about 100,000 to 150,000. So that's probably like the second most largest traded product on the FX suite of products. Now, these are the emerging products which are interesting. I haven't had a great look into these products, but I am very interested in starting to follow some of these products due to what's happening in the world. I think the next 5 to 10 years, I think this space will be a very interesting area, and I think we're going to see a lot of growth in these particular markets. So you've got the Mexican peso, you've got the Brazilian real, you've got the Russian ruble, you've got the South African rand, the Indian rupee, you've got the Chinese renminbi, and also the emerging market FX. So you're looking at, this is the average daily volume is around 2.2 billion. So there's about 85,000 contracts traded on a daily basis. So that's obviously a little bit smaller than the major currencies, but very interesting to follow, very interesting place to be. So Ravi, did you want to share anything about what the CME sees as the future here in the emerging products?
Yeah, so we obviously have lots of interest in some of these currencies because, like you mentioned, emerging market FX is gaining popularity. If you look at NDF volumes globally, they're growing, and some of these products are proxies for NDFs. And Chinese renminbi obviously is, some of this data is a little old. Our volumes have almost doubled since this slide was produced. So that's going to be an important currency going forward globally. So we see a lot of interest from clients to trade that, and that liquidity also is pretty good throughout the day.
Excellent.
And Mexican peso, you can see is 1.39 billion. So that's one of the largest liquidity pools for Mexican peso. It compares well with OTC as well.
Yeah, that's interesting. Interesting figures. So here's the so there's micros available as well. Now this one, the Chinese renminbi, that is actually inverse. So it's actually flipped around, whereas all these others are traded against the US dollar. You can see here that the values is actually in Chinese renminbi. So that's the difference there in these values. But you can see obviously that there's very large leverage in these products, and there is a micro contract as well for the Indian rupee as well as the Chinese product there. So that's interesting that there's a micro there. That I think that'll be very, very popular over time. Now this is interesting as well. Now obviously we don't trade options or anything like that, but this was interesting because Ravi explained this to me today about the if we look at this table, probably the key things to look at here is the skew here, the 25D, and what this basically stands for is you've got the C and the P. That stands for call and puts, right? So basically what calls mean, for people who are not sure about options, what calls are telling people or is telling the market, if there's a higher proportion of calls, it just means people have more of a bullish view on the particular currency. All right. Whereas if there's more puts in the market, then it would mean that there's more of a bearish view on that particular currency. So you can see here the Aussie dollar has a negative amount so it has more puts than calls basically, and that's interesting because it just tells the market that the participant who's analyzing this is that there's probably more of a negative sentiment on the Aussie dollar, and we're actually seeing that at the moment. The Aussie dollar has been quite bullish for the last few months, probably the last half of the year. We've seen quite a good recovery from the Aussie dollar, but it is starting to slow down, and it's looking like it's getting a little bit on the corrective side. So that's a very interesting thing to look at, is just the number of options. I'd never even had thought about looking at option data as a potential bellwether, I should say, bellwether into the direction of the market. But it is interesting when you look at the activity is happening in the options market. Even though we don't trade the options, it's just looking at the correlation there between the puts and the calls. So if you see a negative, if you see that 25D skew here, the RR, the C versus P, or C dash P, it just means calls versus puts. And that's a very interesting piece of analysis you can do, as well as the commitment of trade. I think it's also, if you're interested in currency markets, that commitment of trade figures are very important, particularly what the managed funds are doing is an interesting thing to look at, and also hedge funds as well, those larger players, to see where they're positioned. And generally it's more of a longer term play, but if you do the analysis, if you look at the changes of how the commitment of trade is changing from week to week, because those figures are released from week to week, you can start to see some trends forming, and it can give you more of a long-term sentiment. Look, if you're a short-term trade, it really is not going to make that much difference, but it is good to see that the overall trend in the market. It's important to know what the overall, the larger trends are doing as well, to give you a bit of a background in your trading. So I thought that was an interesting point as well. Ravi, did you want to add anything more about that?
No, I think you covered it pretty well, right? So essentially, option markets are very good bellwethers to direction for spot, because it shows you how the market is positioned in terms of supply and demands. And
Yes.
that 25 delta risk reversal is a very, very common quotation mechanism for option markets. Each of those lines there is different expiries, so you can also see how the positions are changing with expiries. So the X0 is the nearest one, and so on. It goes out further and further. You can see the expiry dates on the right in the second column.
Yes.
So you can also get not just a short-term measure, but even a longer-term measure of positioning. And this is just this week, so you can look at how it is changing over time as well, to see what the market is, how the market's view is changing. There's an important ratio on the right as well, which is the put-call ratio, which is under the open interest column.
This one here.
That one, yeah. So that also shows you what is the open interest of puts versus calls out there. To tell you whether, besides the pricing currently, what is the open interest as well.
Yes.
And if put call is more than one, that means that there are more puts than calls out there. And vice versa if it's significantly less than one.
Yeah. Interesting. So just to go through some of the fundamentals, that if you are looking at these markets from a fundamental perspective, some of the key news announcements that you really need to look at is you need to look at what's happening in the Eurozone in terms of its trade balance. That's one of the key factors to look at. So if you're looking at any of the news sites, like Forex Factory is a great news site to see the red flag news. Trade balance is a good figure to look at. All right, so I encourage you to look at that site or any of those news sites that give calendars as to when news events are coming up. Also, when the central banks are talking interest rates, that can affect currency prices as well. 6E, or the euro versus US dollars, always had a fairly strong correlation to gold, not always, but it's an interesting one to look at. They can work together. So if you look at an increase in gold price, you can sometimes see the euro increase, and we've seen that recently with the euro making a very large run recently from around about that 1.12 level around last year to increasing up to around 1.2 to the US dollar. So we've seen a large run, and obviously gold, we've had a large run as well. So that's an interesting fundamental to look at. Aussie dollar, I think I might have said this before, but Aussie dollar does track the iron ore price a lot. So if you are, if you're interested in studying the Aussie dollar, track it with iron ore prices, and you'll you will see that you will get a nice correlation between the two. Once again, trade balance, interest rates as well. So those government, those Federal Reserves or central bank news announcements can also affect the price in the short term. So these are good news announcements that traders, day traders or longer term traders will look at when they're trading these markets. So let's just have a couple look at a bit of analysis on some of these major currency markets that we currently have at the moment. It's an interesting time right now because if you're looking at the 6E, which is the Euro FX futures, there is very much a long-term or a short-term long bias in place. We are looking to go long on that. And another thing I read today as well is that there's about a $27 billion net short on the US dollar, and most of that is positioned against the euro. So because the euro takes up most of that that trade, so if people are short on the US dollar, obviously, or they're negative on the US dollar, obviously the euro will be stronger. All right, so this is what we're seeing in play right now, is that there's a lot more there's a longer bias on the euro right now. Now there's some key price levels, and I'll go to the charts in a moment, but if you write down these numbers, we're really looking for the euro to hold above 1.17880, 1.18. So there's a buying zone around there that we're really needing to see that market hold above. Now, if it does get below that level, then we could see it head down to 1.17. And if we go below that level, 1.17, then this will erode its positive bias, and we will see a retest of 1.163, which would be underway. So there's a couple of major prices there that we need to look at, and I'll bring over the charts just to give you a bit of an idea of what I'm talking about here. I'll find the so here's the weekly. So this is the weekly chart currently, and we can see we've had a pullback here, fairly significant pullback, and the market is doing a nice swing back up. All right, now, but that's on the weekly chart. Okay, I just want to show you what we've done on the daily, because you'll see these levels a bit more clearly here. All right, so you can see where that top is. So that high's up at 1.20, and I think we're going to retest this high. It's just a little bit uncertain right now because we've still got around about 5 days until about 7 days until the US election, and the market could be probably, I'd say it'd be very choppy sideways until we know more about the US elections and how traders are going to react from there. But you know, the good thing about the market right now, in terms of, and this is where we're seeing from a technical level, where we're seeing a bit more of a bullish sentiment, is that the market is holding above, you know, that diagonal trend line there. We've got a little bit of a wave equality, so we've come up into a little bit of a, you know, like around about 100% fib extension, or close to a 100 fib extension. So we're seeing the market just cool off a little bit here, but I think we've seen, you know, a nice little corrective pullback, and I think we're going to see a retest back up to these highs. So that's why I can see that we're looking for a longer term hold here, and looking to buy at least up to 1.2. Now the problem is, if the market does sell off, there's some key levels, and those key levels were around this level here. First of all, you can see here I've marked it from that high there, that swing up there, but that sort of creates a real pivot. You can see there was a very strong support level around that zone, and the market's already come back to around that zone initially and bounced off it. But it'll be interesting to see how the market holds up around that level there, which is that 1.8 to 1.7885. If the market can't hold that support breaks, then obviously we're looking for a breakdown to 1.17 around this area here, and then obviously if it breaks under there, then we're looking for a retest of this level. And then I think we'll see a very good buying opportunities. If the market can break down here and hold, I'd be looking for some really good longer term buying opportunities. You know, not really suited to the day trader, but definitely more for the someone who trades more, a swing trader, or someone who is a position trader. There'd be some really nice opportunities around that 1.165 area, all right, which is that low across there. So that's the 6E. But I think on a short-term level, if you're a 5-minute trader, it's a very tradable product. Even if I could just show you what the market did today. Let me just bring up the. Now this is the. If you look here, this was in the. You can see here the most of the volume. Most of the volume really started in this European pre-market session. So 5 o'clock and 6 o'clock. This is where we started to see the market, you know, increases in volume. So very tradable during these hours. If you're going to trade the 6E, it's very tradable during the European cash market. A little bit slower in the Asian market. We can see we had a nice trend today, but you can see that trend, or all that movement, was wiped off in basically 1 or 2 hours of trading here. Just to give you an idea of what like a 10-tick trade would be if I drew a box on this chart here, and if you look at these numbers from the right, that's basically 0.0005 of a move. Now, when I showed you those numbers before, 0.0005 of the move was 10 ticks, and that would be a $62.50 price fluctuation. So for instance, you know, if you look here, for instance, this market, you know, selling off down through here, and all these moves down here, like these are basically $62.50 moves. So, you know, that's sort of what the leverage price factor is that we're most focused on when we're trading the futures markets, is these leverage factors, not necessarily this price so much. We just really need to know what the tick value is worth, and then come up with the cash value. And when you work that out, when you have these little 10 tick boxes on your chart, you know what the value is, then you can basically plan financially what each trade would be worth in terms of a win or a loss. So that's important to know. And once again, if you look at the volume down here, this is the current volume which is traded. So, you know, most of the 3 hours of trading that we've seen today, you know, from 5 o'clock, 6, 7 to where we are right now, we've seen, you know, at least consistently holding over 400 contracts, or close to 400 contracts. It's just starting to dribble off now. But if I scroll back to the US cash market, you'll see the volume really picks up in those US cash hours. And you can see here the US pre-market all the way through to the US close. You know, quite a flat day, but still a little bit of price movement there. You know, even considering it was a quiet range, a lot more activity or a lot more volatility in the European session. But once again, the volume is still very high. So you can trade this market pretty much, you know, the volume is very tradable for a day trader, in very much from the European Open all the way through to the US close. There is a lot of volume, a lot more compared to the Asian session. I'll just quickly do a quick run through of the Aussie dollar as well. So with the Aussie dollar, I think the Aussie dollar is a little bit on the softer side. Correction deepened last week down to 0.70, and preference remains for a correction to 0.6850 for longer term buying opportunities. We do have resistance to the upside of 0.716 and 0.72, and we do have support down at 70 cents. So I'll just show you some of the charts. So if we look at the weekly, I believe. So if we look at the weekly chart, you can see we've had a nice rally all the way from after the COVID crash. The market rallied very strongly in alignment with it's actually tracking the US indexes. The Aussie dollar is incredibly uncanny to the S&P and the NASDAQ and the Dow Jones. Very, very correlated at the moment. If you're looking for another market to trade, but you can see here, I think we're going to get a little bit of an ABC pullback here down to that 68.50. So I'm sort of negative a bit on the Aussie dollar right now. I think we're going to come back down to this level at some point, and that's on a weekly chart. So you can see this larger correction, this three-wave correction occurring. We've got a little bit of support or resistance up at that 71.50 level as well, but obviously, you know, 70, which is this low here, we're looking for a break of that level, and I think we break 70, and I think we're going to head back down to this C level here at this 100% fib extension around at 68.50. So that's more of a longer term view on the Aussie dollar. And I think that concludes the night. Now, guys, what we'd like to do is, are there any, before we go to Q&A, if anyone's got any questions, for anyone who's new to the webinar tonight or new to futures, we will be running a futures webinar for brand new traders, people have never traded futures before. So to sort of put all of what I showed you in perspective tonight, we'll be running a webinar tomorrow, the 28th of October at 7 p.m. Queensland time. And that will be, if you want to register for that, that's at idta.com.au/webinar. All right, if you'd like to register for that webinar, I believe it's at 7 p.m. I'm a little bit confused with the time changes because I know this week there's been a big change in the time. So if you do register, it'll definitely give you the exact time of that webinar, but it's I believe it's 6 or 7 p.m. Queensland time. I don't have the time in front of me right now, but if you're interested in finding out a little bit more about how you can trade the futures markets, if you want to register there, then we can show you how we trade them on a daily level. Also, in a fortnight's time, we're going to be running our 4th masterclass, and this will be on agricultural and alternative investment products with Nelson Lowe from the CME Group. So if you're interested in finding out more about agricultural products and the alternative investments that are on the CME, please come to this webinar. It'll be very interesting, especially the agricultural products, because there's lots happening at the moment in terms of the agricultural price, wheat, soybeans, and corn, and those types of products. There's a lot of interesting price movement at the moment, and also has very seasonally affected as well, these markets. So interesting to follow. Now, do we have any questions from anyone while we've got our CME expert here today, Ravi? Yes, Matthew, yes, we do have a recording. That's not a problem. Just waiting on any questions to come in. I think we've answered everyone's questions, Ravi.
Well, I've shared my email address on the first slide. So if anyone has questions, you can always route them through either Rachel or me, directly to me, either way.
Yes, brilliant, fantastic. Oh, well, thank you so much, Ravi. I think everyone's fairly quiet tonight. I think everyone's had their questions answered. But if you are interested in finding out more, please don't hesitate to reach out to us. Yuki, what tool do you use for analysis? We use, depending on what we're looking at, Yuki, we use lots of different tools, but really when I'm looking at a longer term perspective, I'm really just looking at, I'm using significant price levels like trend lines. I'm using significant highs and lows. Also, I'll be using some fib retracement levels as well. So very basic, really, analysis when I'm using when I'm doing large chart analysis. So it's not, it's not overly technical that I'm looking at. I'm looking purely at the prices, the significant prices, and looking also fundamentals as well helps a lot with currencies. I find you need to be able to understand what's happening in terms of news. They're very affected. Currencies are very affected by news. So you do need to make sure you have a good news news website or a news station that covers a lot of information. We use forexfactory.com, and Forex Factory has a lot of great calendars and updates, and a little bit on the commitment of trade as well. But in terms of technicals, really just looking at highs, lows, trend lines, and fibs. Very simple. But for the fundamental stuff is generally, like for now, with waiting for this election, a lot of traders will be sitting on the sidelines just waiting for that news to come out, and that then we can make a decision from there. But a lot of people will really be waiting to see what if we do have a new president, what they're going to do in terms of stimulus, or if Donald Trump remains, what is he going to do in terms of stimulus? If they're going to increase more US dollars into the economy, then that generally devalues the currency. So you'll find that most of the currencies like the Aussie dollar, the euro, but especially the euro, because it is the main currency which is it's traded against the US dollar, you'll find the euro will go up in price in those regards. But there's some of the fundamental factors you look at. Adam, are we able to access Masterclass 1 and 2? Yes, yep, we do have that. If you want to email info@idta.com.au and we can send you that out. Yep, now just email our main email address and we'll be able to send you all that information that you need. Anyway, I think it's almost time up. We do allocate 90 minutes for these webinars. Thank you so much, guys. Hope I answered your question, Yuki, and everyone else. Thanks for sharing. Thanks for participating, being a part of this series. It wouldn't be the same without you, and I'm sure Ravi enjoyed presenting that information and being of great service and assistance to any of the traders that are interested in trading the Forex futures, the FX futures products. So Ravi, thank you so much for joining me on this program, and really look forward to continuing our relationship, and hopefully we can do more of this in the future.
Yeah, thanks for inviting me.
Thanks, Ravi. Thank you, everyone.
Bye-bye.
And we'll see you very soon. Bye for now.